What is going on, everyone? My name is Kenneth Beard here with Stock Indices, where I go over my thoughts on the overall market and I go over economic data reports and I put that all together to make an assumption to make good money making trades. So, if you're tuning in into this video today, I want to thank you very much. Before the video even starts, just hit that subscribe button down below because I make these videos every single day, believe it or not. Every day, I about 1 o'clock, Easter time. I make these videos for you all to have informative information and just have a overall, um, you know, overall knowledge of what is happening in the stock market and the broad indexes. So what we go over here is, as you know, there are four main indexes that I myself go over. Five if you want to include volatility, but we have the Russell 2000, the Dow Jones, the DGIA, the Nasdaq, and the S&P 500. So that's five right there, and those are the five that I normally go over. And then we have volatility, of course, and which is the VIX, the volatility index, showing the fear factor in the market. And so we go over all of those. We come up with what the market is showing us, and we that allows us as traders to gauge which direction we should be going in the market. Should we be going long or should we be going short in the market? And it's just very good knowledge to have when being a stock trader. So, you don't want to be taking long positions in equities in, the tech sector when the S&P 500 is being rotated out of, and we're seeing bearishness in that sector. So, you want to all be in sync. That's how you make the most out of any one trade that you place. So, first thing we're going to do is go over these economic indicator reports. Not all of them came out. I use Market Watch. I think I need to find another one because Market Watch tends to not load all of the indicators as quickly as I'd like them to. But today is Friday, October 15th, and we have retail sales previously coming in at 0.9%, coming in today at 0.7%. Now, we were expected to drop an amazing negative 0.2% for retail sales, which would have been incredible if that happened. But it didn't happen. We just dropped down 0.2%, down to 0.7% for retail sales, indicating that people are spending less money on, things that they shouldn't be spending money on. For whatever reason. It could be COVID. It could be the fact that people just aren't willing to spend money because of this inflation that we are seeing currently in the overall economy. So it could all be different reasons, but the number is that we dropped down 0.2% on the retail sales. We got retail sales excluding autos, which is retail sales for automobile vehicles. We have that coming in at 2.0% previously, expected to be 0.5%, but came in at 0.8%. So that number also is dropping quite a bit. And we can see that that could mean that, it could be a short supply of vehicles that are currently being sold on the market. That could be a reason why, or right now just isn't the best time for people to be buying vehicles. And so people aren't buying vehicles. That could be a reason why, as well as inflation. So, you know, uh, retailers for vehicles may be having these high prices for these vehicles, and people are just not going for it. So we're seeing a sharp decrease in retail sales, excluding autos. Import price index at negative 0.3%, expected to be 0.5%, bouncing to still above to 0.4%. So we just missed off about 0.% on those, which is good. Not that bad for that number. The import price index indicating to us what the import price index is indicating. It is um the price of imported goods and the prices fluctuation. So we see that import price index were negative 0.3%, indicating that the level, the amount that it costed to import those goods and services from domestic regions was very low, but now it's starting to get higher. Could be due to inflation. Like I said, inflation is something that is happening in the economy. Inflation is not a myth. You look at any price of anything uh, 2 years ago or a year ago, inflation was not this high. So during economic recovery, we usually get this, but that could be the reason why. The reason why. So, Empire State Index, we had that come in previously at 34.4%. It was expected to be 26.5%. Came in at 19.8%. So, Empire State Index, um, those numbers are dropping. What the Empire State Index is a number rounded up for the businesses that are included in the Empire State Building, because the Empire State Building has one of the biggest business buildings in the U.S. So those businesses, if those businesses aren't doing as well, if that number is dropping for whatever reason, you know, because of their book of business, it could have an effect on the economy. They can kind of use that information to show, okay, the businesses from the Empire State Index are dropping. That means that overall we could see that small businesses are starting to not do as well in this current period of time. So that's what we're seeing for the Empire State Index, dropping from that 34.4% down to that 19.8%, indicating to us that, for whatever reason, let's click here and see. It usually gives us so New York factory activity moderates in October, Empire State Survey shows. So the New York Fed's Empire State Business Index fell 14.5% to 19.8% in October, the regional Fed bank said Friday. Economists had expected a reading of 25, according to a survey by the Wall Street Journal. Any reading above zero indicates improving conditions. The reading of 34.3% in September was the second highest reading in the wake of the pandemic. Key details: the new orders index slipped 19.4% to 24.3% in October, and the shipment index sank 18 points in 8.9 to 8.9. Unfilled orders showed inch lower by 2.4 points to 18.5. Delivery times widened a bit to a new record high, and both the prices paid and prices received index held near record highs. Optimism about the outlook. Okay. So economists had expected a moderation as most other regional factories index cooled last month. Overall, the picture for the manufacturing remains bring despite supply chain disruptions and price pressures. Empire State Survey. Okay, so yeah, what it's saying is that anything above zero is expanding. But since we did come from 34.3 down to 18, you know, it's still not as good as it was. There's still a shrinkage of some sort. It's still, for whatever reason, becoming lower. So that number is getting lower. So that's for the Empire State Index. Let's go to retail sales here. So sales at retailers rose sharply in September, and a sign that Americans are spending enough money to sustain an economic recovery, but they are also paying more because of the highest U.S. inflation. Like I was saying, retail sales climbed 0.7% last month. So they forecasted a 0.2% decline. Auto sales actually fell last month on an unadjusted basis, but the government's seasonal adjustment process turned a sizable decline into a small increase, record high prices probably also played a role in exaggerating auto sales figures. So, like I said, those expanding prices of automobiles are leading people to keep the cars that they have and stay away from buying new vehicles. So that's all we got for economic indicators. Let's go over these charts now. Looking at the this is SPX. I'm gonna look at the futures. So looking at these E-mini futures here, the S&P 500, still continuing our uptrend, still continuing our spike in price in the SPX, in the SPY, in the S&P 500. We're seeing that we have a second day we opened up even higher, and then it didn't cool down for a second. Yesterday we actually closed with an engulfing candle through that resistance, that downwards resistance that we had, that downtrend resistance line that I have right here. We can see that, that it had an engulfing candle. We actually made a higher low before exploding through. Still low volume, concerning on that part, but as long as we're getting these big engulfing candles, I think that kind of submerges the fact that we're not getting as much volume, because it could just be purely psychological and purely what the market is deciding to do. The market has a mind of its own. So we have a second day of rallying for the market. We look at the 4-hour chart here. We have a level up here. We'll have to see what happens. And we can see that the market is looking strong, but we're going to have to see what happens once we get up here. We'll get up here pretty soon in this day, I'm assuming. And I'm thinking we'll see a little bit of rejection around this level, just because this is like a swing high. So keep a lookout for that. But I think that the market will see, if it's possible that we could get rejected off of that level here that I just marked, and we could make our way back down, to the moving averages, to the 21 and to the 50, and bounce off of that and continue higher, or we could actually come back down all the way to support. Now, the probability of that happening is not as high, but it's something that could happen. Anything could happen in the stock market. So, it's not impossible for that to occur. Now, we could see consolidation at this level. I think, though, with the 3-day green candles that we've been seeing, I think that we will see a pullback or some agreement of selling pressure along these prices that we're having right now. If not this level here, most definitely this level. Around this area, I'm thinking, okay, the market is going to see some cool down before going to all-time highs, at a 52-week high once again. So that's what I'm looking at for the S&P 500. If the S&P 500 drops, all the way below the moving averages, okay, now we have something to worry about. And then, looking at volatility as well, if that spikes, okay, we have something to worry about. But as of right now, nothing to worry about. Just got to keep an eye on those key levels up above. So that is for the E-mini S&P 500. Volatility here. Volatility getting tossed right now. Excuse me. Volatility. To look at it, it's coming down. It's coming down. We're at the 16 level right now, showing us that fear factor that we had in the market. Volatility is slowly, quickly, take that back, each day just being sucked out of the market. Now I don't know if this is artificial or if this is meant to happen. But that's usually how it goes. We get those huge spikes and then decompression of volatility. Once again, though, anytime this volatility wants to, it can spike. So like I said, if we do see a pullback in the broad markets, watch out for the volatility for confirmation. Right now, volatility is confirming to us that the market is seeing an uptrend, decompressing volatility, the sell off of the VIX, and then the uptrend of the regular stock market. So, you know, we want to see volatility stay below this 18 level. You know, once we get that pop right back up to 18, okay, now we have a problem. Pop right back above 20, all right, we got a bigger problem. But as long as we stay below that 2018 level, you know, we're looking good for volatility. So that's for the VIX. Looking at the QQQs here, QQQs, not looking as strong, but still an uptrend. Not looking as strong, but we are seeing a little bit of an indecisive candle right now, seeming like it wants to roll over anytime. But it's only 1 o'clock in the day. We still have a lot of time to go in the day, so we could continue to go higher. But you know, if this fails to go higher, what we don't want to see is this enter back into this downwards range here. If we get back in there, then this is just a false breakout at that point. But as of right now, you know, we have no means to say that that is going to happen. We just have to kind of wait and watch. And volume also very low on this. We're not in any oversold levels. I mean, we're not in any overbought levels yet. So, you know, look, it just turned red. So green to red. We just got to see how that goes for the NASDAQ. RUT, right at that. Wow. So we got right up to that overhead resistance level. We yanked back. Look at that. Look at that hammer. So hammer pulls back, forms a clear hammer candle. If we close like this, we may just see a reversal and we're going to pull right back to that 50 and that 20. Yeah, it's crazy. We've been waiting for this breakout for such a long time. I've been personally waiting for this breakout to see what it's gonna look like. It's like an earthquake or fucking. It's like a shoot. What is it? Like a Yellowstone, which is waiting to erupt here. But we've yet to get it. You know that the sellers are so powerful at that level that whenever demand reaches it, it's just overpowered. So yeah, we're still waiting out on that one. You know, if this fails, if it doesn't just consolidate above, you know, the lows here, if it fails, we open up tomorrow and we close below the previous low day candle, then we're going to see most likely a pull back to this 20 and 50, if not lower. So that's all I got for the RUT. Don't want to make this video too long. And the last one we'll be looking at is bonds. Bonds, wow, look like I said, bonds got up to pretty close to the previous resistance level that we had right here at that 160.18 level. We're seeing a bit of a drag today, and you know, with that being said, though, the market is still looking strong. So, want to see if this level is going to sustain, if it's going to continue. Like, if we continue the downtrend, if we continue to sell off on bonds, you know, that's indicating to us that bonds think that, you know, interest rates are high, and you know, we don't want to see interest rates getting any higher than they are right now. And if they do get higher, you know, the market can start to sell off. So we want to see, you know, exactly how far the bonds are going to pull back. We could pull back down to this resistance level and then kind of consolidate sideways, maybe double bottom before making a move higher. I think that'd make the stock market very stagnant. And, you know, if you go back here and look at ES, if that happens, we could see a potential pullback at this level. And that wouldn't be so well. I mean, it wouldn't be terrible, but you know, we'd be forming now a range in the overall markets. So that's for bonds having a bit of a pullback today after having that great, you know, uptrend in bonds, showing us that interest rates are declining. Interest rates may be going up a little bit today, and we're seeing a pullback, but it hasn't been confirmed yet with the broader markets at all. So until that happens, until it transfer over, it's nothing harmful on our behalf. So That's all I got for you guys today. If you enjoyed this video, like, comment, and subscribe. I make these videos for you all because I like sharing my brain and what I think so you guys can make those good money making trades and see what I'm seeing and just, get an extra feel for to see if somebody is, everyone sees the stock market in a different way. Everyone sees technical analysis in a different way. Everyone reads fundamentals and puts that all together in a different way. But hopefully from my opinions and hopefully from my my way of thinking, you can catch on to something, maybe learn something, or maybe see something that you did not see at first, and it could help you potentially with your trading. So if you enjoy these type of videos, I'm gonna have another video up in the right corner. Click that video, watch my previous videos. I post every single day, 12 to 1 o'clock Eastern time, 12 to 1 o'clock in the 12 to 1 o'clock p.m. Eastern time, so not a.m., p.m. So be looking out for those. And yeah, I will see you on the next one.